There you go.
All right. Thanks for joining, everybody. We're going to give everyone a minute or two to get started. If you can hear us, please share where you're joining us from in the chat.
I think we're gonna wait another 30 seconds or so.
All right. Thanks for everyone joining today. We're really excited to have you and really kind of jump into today's topic. Today, we're really going to be talking about Nvidia's top of the news for many reasons of AI, its valuation growth over the last 2 years, becoming one of the world's most valuable companies. And so we wanted to really do a deep dive on how Nvidia's founder, Jensen Huang, his equity in the company has become worth more than $100 billion. What strategies has he taken to minimize his taxes and at his wealth? Estate taxes, gift and estate taxes are the primary focus. Really dive into what he did, and so you can kind of learn from those strategies. And just as kind of a quick intro we'll get this. Peter, who's our head of estate planning at Valur, he's the one who really did this deep dive, going through Nvidia's their filings to get all of this information. This webinar is really for folks who are, whether it's you yourself or you're an advisor or accountant who works with wealthy clients, it's for people to understand how they can minimize your gift and estate taxes or your client's gift and estate taxes. And so there's kind of an interesting, we'll jump into what that is, but I'll give a quick, Peter, do you want to give a quick overview of yourself?
Yeah. So my name's Peter Tucci. As Mani said, I'm the head of estate planning at Valur. My background is I'm a trust and estates attorney. I joined Valur from a law firm last year. Yeah.
And I'm Mani Mahadevan. I founded Valur. It started with kind of a personal situation of I was fortunate to work for a startup that did really well and IPO'd. I lived in California at the time, and really my goal was, how do I maximize what I keep out of that? And I'm sure there's a lot of Californians on the chat and or other folks in high tax states. It's really, and my goal is, how do I minimize my taxes? So I wasn't focused on the problems that Jensen was. That's not to say there's probably many people on this webinar who are facing gift and estate taxes, or your clients are. But the broad idea of Valur is, how do we help people understand what are the best practice tax mitigation strategies available, whether it's for ordinary income taxes, capital gain taxes, or estate taxes, and really want to help people understand those, understand the qualitative and quantitative benefits and trade-offs, and then really make implementing and administering these seamless. So today's kind of webinar, we'll start with some of the basics of what is a gift and estate tax. This is really what Jensen's focused on solving. We'll go into kind of what is his overall strategy, and then dive into some of the structures he used, how they work, and then kind of walk you through why they're so beneficial for him. And then we'll dive into kind of what are some of the things that he could have done better and leave some time for Q&A. I do want to call out, please feel free to, if you have questions, please put them in the chat. We'll either address them in real time or when they are appropriate, or save them for the end. But we do love questions. So let's kick it off with talking about the gift and estate tax. Peter, you want to give us kind of just a background on what is the gift and estate tax and how does it work?
Yeah. So the gift and estate tax was really two different taxes that are integrated. There's the gift tax and the estate tax. So the gift tax is a tax on lifetime transfers. So if you make a gift to your daughter, you give a house to your daughter, for example, that implicates the gift tax. The estate tax is a tax on transfers when you die, and so if you leave assets to your daughter on your death, that implicates the estate tax. And so the key thing is that both of these taxes share a single unified exemption amount, lifetime exemption amount, which is in 2025, $13.99 million per donor. And so most people don't pay gift or estate tax because they stay below that, almost $14 million lifetime exemption amount. But for people who are going to be above that amount, assets that are passed on beyond that $13.99 million exemption amount are taxed at 40% federally, and at effectively up to 12% outside of by the various states that have their own state estate taxes. So there's a dozen states in DC that impose an estate tax of their own. So it's a pretty significant tax for people who are going to be affected by it.
And I think the other important piece to call out is it may or may not change. And really, again, so Peter's calling out who this applies to, and that kind of threshold where it may apply to you may or may not change. You've kind of got some kind of, I guess, likelihood of that things may not change, but do you want to give a little bit of context on that, Peter?
Yeah, so basically the exemption amount used to be about half of what it is now, inflation adjusted. So it used to be the equivalent of about 7 million. But in 2017, Congress passed the Tax Cuts and Jobs Act, which doubled the exemption amount from that level to the current level. And so, but because of the way the law was passed through budget reconciliation, it had to expire after a certain number of years. And so that expiration is coming up at the end of this year. So December 31st, 2025. And so under current law as it exists, the exemption amount is going to be cut in half from about 14 million to about 7 million, which is going to ensnare a lot more people if it happens, because there's a lot more, there's a lot of people in the $7, $8, $9, $10 million wealth range. So that could be pretty significant. Republicans want to extend the current levels beyond 2025. And so if they're able to get that passed, then, the current levels will continue for however long. But if it doesn't happen, then the exemption amount is going to go down to about $7 million per person.
Yeah, and just to give kind of what is the implications of this? Let's say you had a $20 million estate, you hadn't used any of your exemption. If it keeps the current exemption about 14 million and you're gifting that to your kids, you'd owe the gift or estate exemption, depending on when you give that, on $6 million. The difference between the current exemption of 14 million and your $20 million exemption. This is assuming you're single. So you'd owe 40% of that in taxes. So roughly $2.4 million. Now, on the other hand, let's say the exemption did drop, then that number you would owe that 40% tax on $14 million, which is roughly $5.6 million. So it's a significant increase. Am I missing anything there, Peter?
Yeah, I mean, the other piece is that when you transfer assets out of your estate by gift, for example, to a trust, not only are you getting that dollar amount out of your estate, you're also getting the appreciation out of your estate, the future appreciation. And so, one way of thinking about it is that incremental $7 million of exemption is worth, 7 million times 0.4, since it's a 40% estate tax. But another way of thinking about it is that, if you use that full 7 million incremental amount and that grew to be $30 million by the time you died, really what you'd be saving is, 30 million times 0.4, which is 12 million. So, and there's ways to leverage it even more, but it's potentially just worth a lot of money.
Yeah, and then two final bits on this is, so obviously there's that upfront tax, and then I'm just going to assume everyone on this webinar understands the value of compounding. So that tax that you owe today is obviously worth a lot more in the future. So every incremental dollar you avoid in taxes creates a lot more wealth down the line for your kids in the future. And I think potentially the last and most important point is the gift and estate tax is, correct me if I'm wrong, Peter, it's the easiest tax on individuals to minimize or completely avoid. And really what we're going to be breaking down in this webinar is how Jensen, who's worth north of $100 billion, could completely avoid the gift and estate tax with proper planning. So let's start off with kind of, here's what Jensen did. So Peter, want to kind of a brief overview of what he's done to date?
Yeah, so to give you some context, so Jensen's unique in a bunch of ways. One way he's unique is that he has this highly concentrated position in Nvidia, which is has appreciated tremendously over the last decade. And so the gift and estate tax system, for whatever reason, rewards people who have rapidly appreciating assets. It creates a lot of opportunities for them. And so because of the rapid appreciation of Nvidia, which is like 99% of his net worth, he had a lot of opportunities over the past decade to transfer assets out of his estate. Some of those opportunities he took advantage of, and some of them he didn't, which we're going to talk about. But he's sort of uniquely situated. But the sort of larger strategies apply to anyone who have a gift and estate tax issue. So.
Yeah, 100%. By the way, Jensen's worth kind of estimate is north of $140 billion, where give or take, depending on the latest Nvidia price. The other thing to call out is, Peter, you called out the value of with appreciating assets. Yeah. Generally, a fair assumption that most people who are facing the gift and estate tax do have appreciating assets, that you are facing this problem. So it is applicable to anyone who is facing these taxes as well. Yeah. And so we're going to kind of deep dive into each of these structures, and maybe let's start with GRATs. GRATs stand for Grantor Retained Annuity Trusts. Maybe Peter, do you want to jump into kind of what GRATs are? And I think is this a structure fair to say, is it this or IDGTs that has helped them minimize the most amount of estate taxes?
It's GRATs really in his case. I think GRATs are probably the biggest home run here, but it's a little bit hard. So to give people more context, the reason we know a lot of information about Jensen's estate planning is because when you have shares in a public company and you're an executive or major shareholder, there's certain things that have to be reported about share ownership. And so whenever Jensen transfers shares in Nvidia, he has to file an SEC filing that says he's transferring X number of shares to X trust or whatever. And so we're able to sort of recreate what he's done based on those SEC filings. But we are missing a little bit of information because it doesn't, like, we don't have like the trust agreements, we don't have all the details, but we have a lot of information from those SEC filings. So
Peter, do you mind moving it to the next slide? I mean, the reason we have all this information is exactly what you're saying. And this is where it's like, and I guess the other piece to call out is most wealthy individuals who are passing assets on to future generations are using these strategies. We just have a lot of insight to what Peter's saying of granularity into what he's done to date because of the public filing requirements. Is that?
Yeah.
So
Yeah.
maybe
So I think in his case, almost certainly the biggest the biggest boon has been this GRAT strategy. And so I'll give you some context on what a GRAT is and how it works. But a GRAT stands for Grantor Retained Annuity Trusts. It's a trust that's specifically allowed under it's called Section 2702 of the tax code. But the basic idea is that you set up a trust. You get annuity payments from that trust every year, and those annuity payments are usually set up so that they're equal to the amount that you put in plus essentially interest on that amount. And under the tax rules, as long as the interest plus principal that you're getting back over the course of the term is equal to the amount that you put in plus the IRS interest rate, which is it's called the 75/20 rate. As long as those equal the sort of the minimum amount, whatever's left over at the end of the term gets to pass to whoever you name as beneficiaries, free of any gift or estate tax. And so the idea is, let's say the interest rate is 5%. You need to earn.
The 75/20 rate, or this interest rate you're talking about, it's typically in the 3 to 4.5% range, or 2 to 4.5% range, right?
Yeah. So like during the pandemic, it was even lower than that. It was like almost like less than 1%. Right now, I think it's like 5%.
4.4.
Yeah.
Yeah. I guess another way to state this, by the way, and so the interesting thing about GRATs is they're known as heads you win, tails you lose. Another way to kind of frame this is if you put assets in a GRAT, typically you put them in there for 2 years. If the assets appreciate faster than this, I call it a hurdle rate, the government's 75/20 rate. So let's just say, 2 to 4.5%. If the assets appreciate faster than that, which, on average, even the S&P does, Nvidia has obviously done, the appreciation above that hurdle rate passes on to your kids or the trust for your kids, gift and estate tax free, and doesn't use up that lifetime exemption that Peter mentioned. So that $14 million exemption, the appreciation from a GRAT above that hurdle rate doesn't use up any of that exemption and is free of gift and estate taxes. And so again, to the point of if you have appreciating assets, which generally anyone who's worried about gift and estate taxes does have, the GRAT is a great way to, you can put them in there. The appreciation above that hurdle rate passes on to your kids or future generations, and that principal plus interest comes back to you. Is that missing anything, Peter?
Yeah, that's right. And so in Jensen's case, what happened is so he funded a.
Do you want to jump to the next slide, and maybe we can walk through how this applied to Jensen here?
Yeah. So Jensen and his wife funded 4 GRATs back in 2016, and in 2016, so basically since 2016, the value of Nvidia shares, taking into account stock splits, has increased by well over 100 times. You can see this. You can see this this chart. Even the last 5 years, it's up by 2,300% or something. And so it's even more dramatic if you go back to 2016. And so what happened was Jensen funded these grants. He got the initial funding amount was very low valuation relative to today. The annuity payments were tied to that initial valuation. And so the annuity payments ended up being pretty small relative to the amount that you put in. And there's just been a huge remainder left over for his children. Some of those GRATs, 2 of the GRATs have already paid out to trust for his kids. The other 2 GRATs are still going. We don't know how long they're going to go for, but they'll probably wrap up pretty soon. So it's just been a huge win for him. He's basically transferred or set to transfer about $15 billion to trust for his kids. Those are assets that aren't going to be taxed at 40%. And so that's saving, $6 billion, around $6 billion of gift and estate tax.
Just to make this kind of clear of like how stark this is, of if Jensen had put, today's value of the shares is a $15 billion. He didn't put all of this in those GRATs initially, but if he put all of those, that all of those shares into the GRATs in 2016, that 2.5 million, him and his wife would have kept $3 million of paying out that for this last decade, would have kept all of $3 million of the principal plus the interest payments for themselves. And then $15 billion minus $3 billion would have passed on to his kids and their trusts, gift and estate tax free without using their lifetime exemption. Just to give you an idea of how obviously Nvidia has done extraordinarily well, but how this, like, why the GRAT is so impactful.
Yeah.
And again, this is where that $6 million in tax savings didn't use any of his lifetime gift exemption, didn't have to pay any gift and estate taxes on that $15 billion. And so he saved 40% on that with the GRAT.
Yeah.
And I think the kind of applicable piece is, if you or your clients are worried about gift and estate taxes, but whether you hold assets you expect to appreciate, or even just the S&P, or you hold private assets, which is an entirely different webinar, but you can discount those assets and plan to sell them at some point, GRATs are a really powerful way to pass these assets on and preserve your flexibility of your lifetime gift exemption and avoid gift and estate taxes. Or is there kind of other folks that you think, or use cases that you think are really a great fit for GRATs, Peter?
It's really any volatile asset. So specifically publicly traded stock and crypto, those are sort of the easiest applications. So like Nvidia is a perfect example of this. Bitcoin's a good example. It's also been highly volatile and appreciated a lot over the last few years. But it works for a wide variety of assets. It's a little bit trickier for illiquid assets like real estate, because you have to value the asset every year. So you have to get an appraisal, and it's a little bit trickier. But with publicly traded stock, it's super simple.
Yeah, I'm going to just quickly, I'm just going to share my screen real quickly, just to show you, if you want to calculate kind of what is the value of a GRAT yourself, we have this free calculator we'll add in the chat as well. You can kind of model, the asset value that you include. Let's say you put $1 million into GRAT, you're expecting it to return 10% a year and you're 60 years old. Kind of really, this is showing that how much you can get with a GRAT incrementally to without using GRAT that you can pass on. In this case, it's additional 4 to 5 million. As you increase your growth rate to, say all of a sudden, instead of investing in the market, you start investing in more private equity. You see how these numbers go up further and further, and you're able to pass on more gift and estate tax free. Again, we'll share this calculator in the chat as well. I think there's a couple of questions I see here. There's I'm gonna stop sharing here and pull up some of these questions. So Joseph was here we go. Does the 75-20 rate change over time in the calculation?
Right. So the answer is the 75-20 rate that you use for a GRAT is based on the 75-20 rate in the month that you fund the trust. And so if you funded the GRAT in January 2025, you would use the January 2025 75-20 rate. The 75-20 rate is going to change every month, but you're locked into the one that you have when you funded the trust. And so it doesn't matter if the 75-20 rate goes up or down during the course of the term of the trust. It's whatever it was when you funded it.
There's also a question, what's the lifetime of a GRAT? I'll take this. So it can be anything above 2 years. As a default, this is we have a webinar on this. As a default, you typically do these for 2 years, and there's this concept of a rolling GRAT. You'll set up a GRAT for 2 years. Every year, the GRAT will pay an annuity back to you, and then you can set up another GRAT with those distributions back to you. So the GRAT will be set up for 2 years. At the end of year 1, it'll give you back an annuity payment that you can put into another GRAT. At the end of year 2, you'll get a second annuity payment, and the remainder, whatever's left, will pass on to your kids or the trust that you've designated for them. And the reason behind this is you want to make GRATs as volatile as possible because, again, all the upside passes on to your kids' gift and estate tax free. And if the assets go down, the money just comes back to you. This is where the name heads you win, tails you tie comes from. So you want to make it as volatile because the upside is really good for you, and the downside of volatility leaves you back where you started. There's another question here from Sean about, are the kids paid in stock? So we'll assume, let's just say someone here is fortunate to be Jensen's kids, and he's funded this with Nvidia stock. The remainder will pass on to the kids or their trust, with whatever's left in the trust goes to the kids. So if that's Nvidia stock, S&P stock, Bitcoin, or whatever these assets have been sold for cash, then that's whatever's left in the trust is what's passed on to them. Am I missing anything there, Peter?
Yeah, and so I think he's asking if the kids are paid in kind or in cash, and the answer is that they can be paid in kind. So you can distribute the shares directly to the kids. If you do that, the kids won't pay any tax, but they will have the same basis that you had in the stock. But yeah, it's totally possible. And in fact, if you use a trust as the remainder beneficiary, which is what a lot of people do, the trust can be set up so that you can actually pay the taxes on the capital gains. So let's say you funded a GRAT, passed on a bunch of Nvidia stock to trusts for the benefit of your kids at the end of the term. At that point, you could actually sell the stock. Your kids wouldn't pay the tax. The trust wouldn't pay the tax. You would pay the tax on the capital gain for them, and it would sort of be like a gift to them, except that it wouldn't be treated as a gift for gift tax purposes. So that's a thing that a lot of people do.
Peter, you want to take this one?
Yeah. So this is so does the 75/20 rate determine the maximum distribution from the GRAT? If rates go up, can this change? So So basically, the 75/20 rate determines how big the annuity has to be in order for you to not be making a gift to your kids. And so you want the annuity payment to be large enough so that the IRS says that the amount that you're getting back from the trust in the form of the annuity payments is sufficient so that whatever's left over is not treated as a gift to your kids or whoever the beneficiaries are. So the 75/20 rate determines the annuity payment amount. It's also based on the length of the trust. So the longer the trust, the lower the annual annuity payments have to be to add up to 100% plus the interest rate cumulatively. If rates go up, can this change? So again, you're locked in with the initial 75/20 rate, and so whatever the 75/20 rate is in the month that you fund the trust, that's the 75/20 rate for that trust. You can change. You can fund a new trust in 3 months, and it'll have a different 75/20 rate because 75/20 rate will be different in 3 months. But it doesn't matter what happens to the 75/20 rate after you funded the GRAT. You're locked in for the term.
Yeah. And before we move on from GRATs, I'm going to give, this is my favorite kind of anecdote, or I guess with the origin story, well, not origin story of GRATs, but an interesting kind of anecdote about this is, so one of the things that Peter mentioned is the kind of annuity payments and that 75/20 rate. Essentially what you're doing is you're making sure that the value of those equals the present value or your contribution value when you contribute the assets to the trust. An interesting piece is part of the way that GRATs have been kind of formed this way is the Walton family, the family behind Walmart. They, when there was a law change from the IRS was passed a law to ban previously what was the most favorable and used estate planning strategy. They're called GRATs. The estate planning space is known for very exciting acronyms. And when they did that, the Walton family, they're not the Walton family, their family office noticed an opportunity. And so then this is where they started to take advantage of GRATs. And they found this kind of, they're able to make these loopholes work for them. And the IRS actually sued them. And initially the IRS won. It got escalated and appealed to the Supreme Court. And the Walton family won at the Supreme Court. And as a result, these kind of 2-year called backloaded zeroed out GRATs have become kind of the default best practice for this strategy as a result. So let's can move on to the second kind of plank of Jensen's strategy is intentionally defective grantor trusts. Peter, you want to give kind of the overview here?
Yeah. So intentionally defective grantor trusts, basically they're a type of trust that usually you use to use up your gift and estate exemption amount. And so right now that's $13.99 million. Back in 2012, when Jensen and his wife made these gifts, it was lower than that, but yeah, around 5.5 million, I think. But yeah, so the idea is that you transfer assets to the trust. The trust is a disregarded taxpayer for income tax purposes, but not for gift and estate tax purposes. So you transfer the assets. The assets are outside of your estate, and so any appreciation is outside of your estate. So if you transfer, let's say, $10 million to Intentionally Defective Grantor Trust, and say it has an Nvidia stock, and the value of that stock grows, that $10 million might end up being worth $1 billion after 3,000% or 5,000% appreciation. So you can really transfer a lot of assets that way. The other big benefit, there's a few. The other big benefit of Intentionally Defective Grantor Trust is that because you're allowed to pay the taxes without those tax payments being considered gifts, you can essentially transfer millions more to your children without using any gift tax exemption. And so in Jensen's case, he has tens of millions of shares of Nvidia in these Intentionally Defective Grantor Trusts that he created in 2012, I think. And those shares are throwing off dividends. Nvidia doesn't pay a huge dividend, but when you have tens of millions of shares in these trusts, the dividends are still pretty substantial. And so the dividend income on those shares throw off. Those taxes are actually paid by Jensen, not his kids, not their trusts. And so every year, Jensen's making he's probably paying tens of millions of dollars of taxes on these shares, and those tax payments aren't considered gifts. So that's
and it's Peter's talking about it. It is a really impactful piece. Another way to state this is you have this lifetime exemption of how much you can gift to your kids, future generations. But critically, with IDGTs, you can gift them that $14 million, but that when if you sell your Nvidia stock appreciates to $1 billion and then you sell that and there's taxes due on that, instead of your kids or the trust paying those taxes, you do. And the impact of that is, if you're worried about the estate tax, it means that you lower the size of your estate and the future estate taxes you will owe. But it also means that your kids or the trust, they stay whole on the sale. They get to essentially grow tax-free because you're paying the taxes. And all that growth happens outside of your estate, free of gift and estate taxes and using up your lifetime exemption. And so this is where that compounding and the duality of the assets grow tax-free outside of your estate and then the size of your estate grows smaller really creates a powerful, it makes these intentionally defective grantor trusts known as IDGTs, makes them potentially the most powerful way to avoid gift and estate taxes if you are over the exemption, if you're significantly over the exemption. Is that kind of fair, Peter?
Yeah. And the other thing is, oftentimes the way these trusts get assets is not from making direct gifts to them, but rather from naming them as the remainder beneficiaries of a GRAT. And so in this case, I think a lot of these IDGTs got their assets actually from the GRATs that Jensen and his wife have been setting up over time. And so, the idea is that instead of naming your kids individually as beneficiaries of the trust, the GRAT, you can name these trusts as beneficiaries.
Yeah. And this is exactly. It's a great thing to call out is you can stack these things on top. We talk about the benefits, we're talking about them in isolation because it's just to help you guys understand the basics, how they work. But you can stack these things on top of each other. Let's maybe jump to kind of how his charitable giving strategy.
Yeah. So Jensen and his wife have also made a lot of charitable gifts. Some of them have been made to his donor advised fund called GForce. GForce Donor Advised Fund, and some of his charitable gifts have been made to a private foundation called the Jensen and Lori Wang Foundation, which is a private foundation that the two of them control as board members. So why do this? So it's not really a tax strategy per se, although it does save a lot of taxes. So it saves income taxes because Jensen and his wife get basically 30% income tax deductions, 20% for the foundation, but 30% for the DAF. Whenever they, they get 100%. They get 100% charitable
And just to be
deduction,
clear, what that
limited to
means,
30% or 20% of adjusted gross
if
income.
they give $1 million to those
Yeah.
things, they get $1 million charitable deduction,
Yeah.
which means they can lower their taxable income from $10 million to 9. If they give $1 million to their foundation or DAF, they get $1 million deduction to reduce their, let's say their income was $10 million, they would go from $10 million to $9 million. When Peter says 30 or 60%, there are limitations on how much of your income in a given year you can write off, and it's a percentage of what's called your adjusted gross income or your total income, and that it's a percentage that depends on who what's the charitable beneficiary and the type of asset you donate, right?
Yeah. So in Jensen's case, he's effectively getting 30% or 20% annual deductions because the amounts that he's giving to charity are so large that I doubt his AGI is high enough to cover. So like if you give, if your income is $50 million and you're contributing $1 billion a year to charity, you're never going to be able to use that full charitable deduction because you're going to be limited to maybe 30% a year, and you're just never going to be able to use it. And so in his case, he's probably getting 30% annual charitable deductions, but that means that if his income would normally be $50 million, it's going to be $35 million instead. And so that's an income tax savings. And then also the assets, because they're outside of his estate, when he dies, there's not going to be estate tax on those amounts that he's given to the DAF and the foundation. Now, like, are his kids better off because he's given all this money to a foundation and a DAF? Probably not in absolute terms, because every dollar you give to charity is a dollar that you're not getting personally, and donor advised funds and foundations, when you give away the money, that money's gone. You're not getting anything back as a remainder. So it's probably not it's not really enriching his kids. Like, it's not like if you're trying to save estate tax, you would give money to a donor advised fund. But if you're charitable, it's a pretty efficient way to give to charity.
Yeah. And before we go, I'm just going to pull up. I know there's kind of a couple different strategies here, and first of all, if you're worried about gifts and estate taxes, it's obviously a good position to be in. I'm just going to share we have a tool that can help you understand what are these structures and what's the financial benefits. So we call it's our comparison tool, where you can select which types of structures. We've talked about these IDGTs, these GRATs. We're not talking about Crumbly Trust today, SLATs, irrevocable life insurance trusts. You can do this, select based on where you live, how old you are, your net worth, how much you're looking to contribute, kind of all these other inputs. And you can actually see what is the value of these structures on a relative basis. What's the highest yielding ones? What are some other options that make sense here? And really deep dive into what are the year-by-year numbers over time? How do they look like over different time horizons? And what are the other trade-offs and benefits, whether you retain control, there's distribution, if you're able to take liquidity or loans from the trust back to yourself, or swap assets with the trust based on kind of those pieces. So this is, I'll share this in the chat as well, but all of these tools are kind of to help you understand the trade-offs, qualitatively and quantitatively, and benefits of these structures to help you make a better decision and move forward. We also are always free to chat with you if you have questions, and we'll include some of those links at the end. Maybe we move kind of on to the kind of next side of what could he have done better? So this is kind of an even deeper dive. So obviously Jensen's he's passed on tens of billions of dollars to his kids, but he could transfer another 70 billion plus if he had done more optimization. And this is all kind of some deep dive work that Peter's done here, but there's an important caveat. Obviously, Nvidia has probably done better than even Jensen imagined over the last couple of years, so it's a little hard to predict that. And also, his goal may not have been to maximize his tax savings and pass everything on to his kids. But we're coming from a point of, if you really want to optimize and maximize this, how do you approach this? So maybe Peter, kind of with that, what are the two things that he could have really done to move the needle here?
Yeah, so the two sort of obvious things are, so he made these pretty large gifts to GRATs back in 2016, but he didn't give away like all of his shares, and maybe he couldn't have for practical reasons. But if he had, it would have moved an additional basically $60 billion of assets into trust for his children, and so that would have dramatically reduced his future estate tax exposure, and that $60 billion is going to grow to be Nvidia keeps going up like it's going up. It'll be an insane amount. Even if it doesn't, even if it just appreciates at 10% a year for the next 40 years, however long Jensen lives, that'll easily be hundreds of billions of dollars of wealth that he could have gotten out of his estate, but he didn't. My guess is that Jensen knows that his kids are going to get tens of billions of dollars anyways. And so it's just such an extreme situation that he's probably not that worried about estate tax. So like billionaires have a different outlook than people with $20 million. But yeah, he could have done that in theory. And then the other thing he could have done, so we mentioned that he made large gifts, equivalent today of billions of dollars of shares to his private foundation and also his donor advised fund. What he could have done instead is made gifts to what's called a Charitable Annuity Trust. So a Charitable Annuity Trust, it's kind of like a GRAT in some ways. So it's the same idea. You have a 75-20 rate, and you have annuity payments every year for a certain number of years. The difference is, instead of the annuity payments being paid to you, the annuity payments are paid to some charity. And so he could have set up a CLAT and named a DAF, his DAF or his private foundation, as the remainder beneficiaries. And if he had done that, not only would he have gotten the same charitable deductions that he wound up getting anyways for income tax purposes, and not only would he have gotten assets out of his estate, but to the extent that his assets appreciated faster than the 75-20 rate, the remainder, like with the GRAT, the remainder would have gone to his kids. And so, depending on the terms of the CLAT, he could have transferred a significant amount, very significant, to his children that way, while still getting the same charitable and tax benefits that he ended up getting anyways.
Yeah, and it's a great, like, CLATs are a great way for people to pass on if you're, again, over the lifetime gift exemption or expect to be. Important and very important caveat is you don't necessarily have to be over the lifetime gift exemption today, but if you expect to be, this estate tax planning can be really important. But CLATs are a great way for people who are worried about gift and estate taxes to pass on assets to their kid if you're also charitably inclined. It's like a really powerful combination in that sense.
Yeah.
There's a question. Oh, sorry, go ahead.
I was going to say, we just got a question from Dennis about CRUTs. And so I don't know if we have time to get into CRUTs and how CRUTs work.
Yeah, I'll give it. Yeah, go ahead. We don't have to
say the short answer to your question is yes. But also keep in mind the distributions from if you have appreciated assets in a GRAT, those distributions back to you, the annuity payments, aren't taxable. So there's no tax consequences in you getting a distribution. And so if that's what you're worried about, that's actually not gonna trigger any tax. When you go to eventually sell the asset, there will be a capital gain event when you sell. And so you could take advantage of a CRUT in that situation.
Yeah, and I'd say, like, let's play this out for Jensen's situation. Is he uses GRAT he puts X million dollars into the GRAT, it appreciates a ton. A lot of it goes to his kids. Some of it comes back to him and his wife. If either Jensen and his wife want to sell the shares or their kids want to sell the shares, they could set up a CRUT and sell those on a tax deferred basis. And so instead of paying taxes when they sell those Nvidia shares, they can sell them pre-tax, reinvest the money pre-tax, and have it grow pre-tax to, again, create more wealth. You get to avoid gift and estate taxes, keep your lifetime exemption, and then also defer capital gains taxes. And this is where you can stack these structures on top of each other to create even more benefit. So one, just wanted to thank everyone for taking the time to join us. We hope this was helpful. Please always give us feedback. And if you don't know where to get started, one, you can always, we're going to send out this webinar with videos and some of these key links. You can always set up time to chat with us. You can email us. You can also use, if you're not sure which structure or what problem you want to use, you can start with, we have a tool called the Guided Planner, which can help you understand what problem you're solving, what are some of the structures. We have the comparison tool to help you understand if you're solving for ordinary income, capital gain taxes, or estate taxes, what is the relative ROI and liquidity of these different structures? And then we have deep dive calculators to help you understand it. And then you can also set these structures up online or set up time with us to understand more. But once again, thanks for taking the time to join us. And I also want to give we have webinars every week at the same time. Next week's going to be, it's focused for advisors, whether you're a financial advisor or accountant who wants to bring this value to your client. And we're going to just show you how you can incorporate some of these tools and planning into kind of your, whether it's quarterly or annual meetings with your clients to help understand the value, service opportunities, and bring that value to clients. And then on January 22nd, we'll be talking about renewable energy opportunities for 2025. Thanks again, and hope everyone has a great rest of their day.